You're listening to The Moose and the Loose, your 10 minutes action-packed financial podcast with your host, Mikey Hu. Hey, what's up, Market Moose? Mike from The Moose and the Loose. I hope you're doing well on this Thursday. As you are listening to this podcast, I am packing my stuff to go to Iceland for 2 weeks. Don't worry, though, I have made sure that I am pre-recording a few episodes, so you should have a lot of things to listen to on The Moose for the next 2 weeks. While I am hiking, rafting, kayaking, and even horseback riding. So it's going to be a lot of fun over there, a lot of outdoor activities. So I'm really looking forward to it. As promised, today we are looking at Canadian banks. Yeah, see, I'm not even able to talk because I'm thinking of them and I'm thinking of the returns and I'm like, damn, it's not that great, right? So besides investing in National Bank, are there anything good in the Big Five? So what's going on? And unfortunately, there's only one investable bank right now, in my opinion. Like all of the others will have a relatively high level of risk. We're going to look into those, but there are some pretty solid bear cases right now for most Canadian banks of the Big Five. All right, so let's get started with Scotia Bank. This one last year, when they grew their dividend only once and only by 3%. And actually, it was, I think, 2 years ago. Anyways, I just told my members, be careful. Be careful because Scotia Bank shows the highest payout ratio and the weakest dividend growth policy. They used to increase their dividend twice a year. They didn't do it in 22, didn't do it in 23, and then 24, they just said, oh yeah, well, we're just not going to increase it this time. So of course, they're not about to cut their dividend, but definitely it is a big sign that they're not doing that well. So it was prudent management, and I'm totally fine with that. But as I said earlier in another podcast, my problem is not with what they do right now, but what they did in the past 5 and 10 years to get to that level, thinking that investing massively to grow their business in South America and Central America would actually generate more profit and more revenue. Unfortunately, it just generated a lot more volatility. So now there's a new chief in town. They changed their CEO last year, I think, and there's some hope that it's going to turn around. But in the meantime, I would not stay invested in this one if it was in my portfolio, because in absence of dividend growth, especially for such a big company like this, that's definitely failing their shareholders. So right now, I don't see why I would put $1 in Scotiabank for all of those reasons. Another one I'm not a big fan of, CIBC. CIBC lack of vision. Like each bank, like for the better or for the worse, they have a clear strategy. They have a clear identity. We just talked about Scotiabank being an international one. We're going to talk in a second about TD expanding their business in the US. Each Canadian bank has their clear identity, clear vision, but CIBC, they're doing a little bit of everything. So they're a little bit on the wealth management team. They are expanding in the US. Now they're having some major provision for credit losses there, so it's harder for them to grow in the US than expected. They're trying to fight each fight without necessarily a clear vision, and that is the biggest problem for CIBC. So one of the reasons why it shows a higher yield, similar to BNS, is mostly because the market doesn't see enough growth vectors here as opposed to the others. And when you look at the dividend triangle, again, not that clear that they're going to outperform the others because they lag behind on revenue, earnings, and dividend metrics as well. So Scotiabank, CIBC, they've been on my I don't like them list for a while, so they're going to stay in the penalty box in my mind. Now moving on to BMO. BMO is known to report hectic quarters because they focus a lot on the market with capital markets, investment, creating ETFs, and sometimes they have like a bad quarter. But recently, their latest quarter, it was driven by highest provision for credit losses on the U.S. side, which came as a surprise a little bit. And right now, BMO's having like a tough time to manage through their banking activities and generating a lot of profit from capital markets at the same time. So again, a lot of like dark clouds coming around BMO. And keep in mind, now I'm talking about what just recently happened for those three, for Scotia Bank, CIBC, and BMO. But we have not felt too much yet the impact of higher interest rate in Canada. So the economy is surprisingly resilient, but there's still a chance that we're going to have a mortgage crisis at one point. And if it happens, well, all banks are going to get hit. Even my favorite national bank, they're all going to get hit. So that's another dark cloud looming around for another bear case. So for BMO, it's going to be hard going forward because they're not done with their loan, their loans and their protection for credit losses in the U.S. Some like I wouldn't be surprised that it would be a bad year altogether. So the next 6 months probably not going to be that great for BMO either. Now moving on to one of my past favorite. I still love the business model. I still think that there's a lot of growth coming up. But right now, everything is put on hold because there is a major investigation around anti-money laundering practices. TD is getting hit by the DOJ in the US, so that is going to be a bit tougher for them because we don't know what's going to happen with the result of this investigation. So I see it right now as a high risk, high reward play. Because if they get slapped with a fine, it's going to be a very bad year for them. But after that, they're going to continue to generate growth and they will pass this problem. If the worst case scenario happen and they get capped with a limit by the U.S. government, and U.S. government will likely really love to make an example that is not even a US-based company and probably just show the world, do not mess with us. So if they do that and they cap the TD's growth in the US, this means that their biggest growth vector will be put on the shelf for maybe 5 years, maybe 10 years, and it's going to be a long road for TD to recover from this. Because if there's no growth vectors and they're stuck in Canada, I mean, they're going to do well. They're going to do okay, but we're not going to talk about like a bank that will be growing, and other banks are definitely going to benefit from this. So at this point, I still like TD's business model, but the investigation brings a heavy load of uncertainties around this stock. So it's, again, a tough one to make at this point. The last one, but certainly not the least, Royal Bank. Royal Bank, in my opinion, is the most investable Canadian bank besides National right now, because it's as well diversified. They have reported good quarters as of late. Their PCLs are under control. I like the fact that only 50% of their business is related to banking activities. So if we get hit with a mortgage crisis, they're still going to be able to generate money from wealth management, their insurance segment, and also their capital markets. And for those reasons, I think that Royal Bank does not have it has the less dark clouds around their heads as opposed to all the others that have like strong bear case against them. So overall, not a good year for banks. Royal Bank is probably the one that will get out of it in a good way, and National Bank remains my favorite because this one right now seems to not slow down for any reason. I wanted to offer you something, Moose, today. I did a complete Canadian ranking bank guide, so you will have all my thoughts about the 6 banks. I reviewed their business model, I reviewed their dividend triangle, I reviewed their perspective. So you can download it for free at moosemarkets.com/newsletter. So you just subscribe to the newsletter, you're going to receive the confirmation, and once you confirm that you allow me to send you emails, I'm going to direct you where you can download the Canadian Bank ranking. So moosemarkets.com/newsletter. It's 100% free, no string attached. It's just that I want to start a communication with you guys, and this is my way to help you even more by providing you more free resources. So moosemarkets.com/newsletter for the Canadian Bank ranking guide. And if not, I hope that you have enjoyed this episode. Tomorrow, we are talking about, should you pay for a coach either as an individual or for your business? So stay tuned and stay invested.
Hey, welcome to the disclaimer. If you're listening to The Moose and the Loose, you cannot really expect me to give you buy or sell recommendation or financial advice, right? You're here for fun, you're here for information and some entertainment. But I am not your financial advisor, I am not your broker, so therefore I'm not liable if you're losing money after listening to the podcast. If you're looking for some advice, go see a professional. If not, you can enjoy this show and do your due diligence after it.